a buy recommendation on Block. So moving on to my next stock the next stock, Airbnb. In terms of its performance for the first quarter, the first quarter revenue and PATMI was at 19% and 9% of our full year forecasts. So this was mainly because the first quarter it's usually weak for Airbnb, and the profitability is expected to surge in the second half of 2024, mainly because of rebound in summer travel demand. So the total revenue for Airbnb, it grew by about 18% year over year. And this is mainly because of 10% growth in its booking volumes. And management highlighted that it witnessed strength in Asia Pacific and Latin America regions, where the booking volumes, they surged by about 20% year over year. And also the cross-border trips, they grew by about 10% year over year. And this particular segment, the cross-border trips, it now accounts for 46% of the total bookings volumes, which comes to about nearly 60 million nights booked. And also the active listings on its platform continued to increase by about 17% year over year. And this is mainly because of continuous support that it provides to the hosts, and also continuous product developments. In terms of the bottom line, its net margin, it also improved from 6% in the first quarter of 2023 to 12% this year. And this is mainly because of higher operating leverage and a 38% jump in its interest income. So moving on to the negative for the current quarter, June ended quarter, it has provided a weak revenue guidance. So it expects revenue to grow by about 9% year over year. And this is a significant drop from 18% in the first quarter. And management highlighted that the significant drop, it's mainly because of the Easter holiday, which this year came in March. And as a result, the volumes, the holiday related bookings, they were shifted to the first quarter. And however, in the third quarter, it expects its revenue growth rate to accelerate, and this is mainly because of strong travel demand around the summer, and mainly because of the international events like Olympics and the Euro Cup. So lastly, for the full year, the management, it reiterated its EBITDA margin outlook of about 35% this year, and as compared to 37% in the FY23. And this is mainly because it plans to reinvest into its business. In terms of valuations, we maintain our neutral recommendation with a unchanged target price of $150. And this is mainly because we believe that the booking volumes for Airbnb, it has been consistently decreasing, and this is mainly because of the moderating travel demand. And we believe that the growth has already priced in, and as a result, we maintain a neutral recommendation on Airbnb. So that's all for me. I would now like to pass it on to Helena for Apple.
Thank you, Ambrish. So Apple reviewed their second quarter earnings. Next slide, thank you. So their results are within our expectations. Revenue dropped 4.3% year on year due to a 10.5% year on year drop in iPhone sales. We expected them to review about AI, but they haven't. So that also remains uncertain. And last but not least, they have unveiled a $110 billion buyback. Jumping straight to the positive and negative. For the positive, Apple delivered pretty strong gross margin. Their second quarter gross margin is 46.6%, which increased 2.3% year on year, beating its guided range, despite a decline in revenue. Their margin expansion is driven by, first, a higher mix of services. Things like Google Payment practically has 100% gross margin. And second is a higher mix of products. So Apple do notice that the consumers are preferring the more premium model, as in the Pro series. So as for the negatives, the most obvious one, weakness still persists in their revenue performance. Their revenue declined 4.3% year on year, which is persistently low demand for its product, especially if you compare with its other tech peers, then this is significantly low. So iPhone sales have declined for the second consecutive quarter, dropping by 10.5% year on year. This decline is primarily attributed to the weak performance in the China market, with a decrease of 8.1% year on year, influenced by their slowing economy and increasing competition from local rivals like Huawei. Although the decline was less than expected, Apple's revenue performance overall has been pretty sluggish. Another negative point is that they did not reveal any AI strategy. Unlike other big tech rivals who are pretty transparent with their upcoming AI features, they're clearly lagging behind. Despite they do assure investors that, oh, AI is deeply embedded within services and software, but we haven't seen any clear picture yet. But they do indicate that they have plans to unveil more details in the week ahead. So presumably that's waiting until its Worldwide Developer Conference, which is going to happen in mid-June, 10th of June. So whether Apple can capitalize on the AI boom and unveil new AI features in the upcoming iPhone will definitely influence its short and long-term outlook. So moving on to the outlook, they have guided the third quarter revenue growth of single-digit year-on-year. They also guided double-digit growth in services and iPads, so that kind of translate to single-digit decline in iPhone sales. We have maintained our target price at 194, mainly because their sluggish demand is kind of within expectation, and also because they haven't revealed anything about their AI strategy yet. So it's a little bit hard to tell how they're gonna go from here. We actually upgraded to accumulate. This is mainly just due to the recent share price loss. So it kind of bounced it up to accumulate. That's all from me. I'll pass my time to John for Magnificent Seven. Oh, pass to Meow Meow.
Yeah, thank you, Helena. I'll go through the list. They released the third quarter 24 result last week, and no financials were provided. Committed portfolio occupancy rate decreased by 11% year-on-year to 88.8% in the face of departure of anchor tenant of Sky Complex, which returned 1/3 of the space. However, on a quarter-on-quarter basis, it improved by 0.9% due to the backfilling of Sky Complex by 8.1%. And something positive about them is their robust retail rental reversion of 15.3%.
Recording stopped.
Sorry, I think Meow got disconnected. She's rejoining now.
So sorry, I have some technical issue. I'll record the session. Give me a minute. Yeah, sorry, Ambrish, can I have access to record the session?
Oh, sure. Let me just check.
Yeah, I'll continue at the meantime. Yeah, so sorry, something positive about Lendlease is their rental reversion was very robust.
Recording in progress.
Yeah, they achieved 15.3% in total, with 3 SMSI achieving 20% and GM delivering a very stable performance of 10%. And retail rental reversion for the office saw a slight cooling down, landed at 1.5% in third quarter 24. However, stable support will come from tenants with longer leasing period, contributed by around 22% of the total gross rental income. We expect the rental reversion for the whole year FY24 to be around 15% compared to last year 4.8%. And second one is they also have some potential rental uplift from GEM and also Sky Complex in Milan. We anticipate rental upside from Building 3 Sky Complex Mainland, driven by healthy office demand in the surrounding area and lower than average rental rate previously signed by Sky Italia. In third quarter 24, L-REIT also secured 8.1% of the net lettable area of the lease through internal sourcing. And L-REIT expect the backfilling to be completed by the end of 2024, with the rental reversion of 30% to 40% to match the current market rate. GEM is also reviewing its rental at the end of 2024, and the current market rental is around 20% higher than the previous rent signed by the anchor tenant. We expect rental escalation to be in around like high teens, resulting in an improvement in revenue by around 2% upon successful backfilling. As for outlook, there is some delay in the construction. Sorry, can you all hear me? And for outlook, there's some delay in the construction of Live Nation. L-REIT updated that they are currently in the cost budgeting stage. Since construction usually takes 1 year to complete, we expect Live Nation to be introduced by second half 2025. With a capacity of more than 2,000 concert going per event, 4 events per day will translate into additional footfall of 1 million per year. This is around 2.5% of the total Suran at Somerset's footfall per year. So this would lead to a higher GTO and reduction in occupancy rate, thus paving the way for future rental reversion. And for Sky Complex in Milan, currently they see demand from F&B and real estate sector. L-REIT doesn't have a specific sector coverage and is seeing more expansion demand from small to mid-size inquiries. So we maintain a buy recommendation and an unchanged target price of $0.83. L-REIT is currently trading at FY24 dividend yield of 7.5% and 0.7 times price to NAV. Yeah, that's all for me. I'll hand over to Glenn.
Thanks, Mel. Yeah, okay. So for me, we have the two of the remaining local banks results. We're starting off first with UOB. They released the results first before OCBC. So for UOB, their first quarter adjusted earnings of 1.6 billion met our estimates as the higher fee income and other non-interest income were offset by lower than expected net interest income as well as higher expenses. So the first quarter PATMI was at 25% of our forecast. Jumping straight to the positives, first positive being that their fee income has continued to grow. So fees grew around 5%, and this was mainly due to higher related loan fees, which grew 3% year-on-year, as well as a pickup in wealth management fees by 6% year-on-year, mainly due to a return in investor confidence. So notably, their wealth management assets under management, so wealth management AUM, grew 11% year-on-year. And their credit card fees also continued to grow and it reached 90 billion in the first quarter. So this is representing an 11% increase year-on-year. And their fee income makes up around 16% of their total income. So it's the same as the year before. For the second positive is that their trading and investment income rose 10% year-on-year. And this growth was led by customer-related treasury income, hitting a record level of 219 million. And it also grew by 8% year-on-year. And this was mainly from increased retail bond sales as well as strong hedging demands. Their trading and liquidity management activities also continued to perform well, growing by 11% year-on-year. Lastly, the last positive is that their credit costs and new NPAs dipped year-on-year for the first quarter. Credit costs fell 2 basis points to 23 basis points as the total allowances were slightly lower by 3%, mainly due to a decline in their specific provisions on lower NPL formation, while their general provisions remain stable. The new NPA formation also dipped by 17% year-on-year as the asset quality stabilized during the year. So resultantly, we're looking at their NPL ratio, it improved by 10 basis points to 1.5%. And their first quarter NPA coverage is also at 99%, with unsecured NPA coverage at 204%. We have one negative, and that is mainly that their net interest income did fall as their NIMs also fell. So net interest income dipped 2%, This is mainly from their net interest margins falling 12 basis points year-on-year to 2.02%, mainly due to loan margin compression from competition for high-quality credits as well as high cost of funding. And the high cost of funding, we have seen for UOB that they have lowered their flagship one account savings interest rate, but then again, this impact from this recent deposit repricing is yet to be felt. So it only kicked in, I think, on the 1st of May. So it's probably going to come in the second half or even in the second quarter of this year. So we should see their NIMs possibly actually inching upwards instead of going down. But that's really hard to tell because we have to see how they shift around their assets and whether they are putting it into higher yielding interest. Yep. So for the outlook, we do expect that UOB's profit will continue to grow by around 8% in 2024. This will be on the back of stable margins, loan growth recovery, as well as stronger fees and stable provisions. We also expect credit costs to come in around their guidance of 25 basis points. They have guided for low single digits loans growth, as well as the NIMs to hold above 2% for the rest of the year, and for their cost to income ratio to remain stable at around 41 to 42%. For fee income, we are expecting a double-digit fee income, which could add around 220 million to revenue. And this growth will be led by credit card fees and wealth and fund management fees as the market sentiment recovers. So, similarly, for all the three banks, why the wealth management fee income would recover is because as people expect the rates to drop, they will start to pull out money from their deposits, and also deposits rates are getting lower, so they will pull this money out of their deposits and then they will put it into sort of like higher risk, higher yielding investment products, which mainly contribute to the bank's wealth management fee income. And lastly, for loans growth, we do expect to see some demands pick back up with rate cuts expected in the second half, and they are guiding for a low single-digit loans growth. And most of the growth will come from the ASEAN region, also contributed by their UOB, Citi assets. So we do maintain a buy with an unchanged target price of $34.90. And for UOB, FY24 will be another year of growth from stable NIMs, loans recovery, and double-digit fee income growth, which will boost their earnings. Now, moving on to the next counter I have, which will be OCBC. So for OCBC, I'll first do the results, and then we will go to the hot topic, which is the acquisition of they gave for Great Eastern. So for their results, firstly, their first quarter earnings of 1.98 billion were slightly above our estimates, mainly due to higher non-interest income from growth in their fee, insurance, and trading income, and moderate growth in their net interest income, which was offset by higher allowances and expenses. So their first quarter PATMI was at 28% of our forecast. For the positives, first positive is their non-interest income rose 17% year-on-year. And this growth was from broad-based fee income, trading, and insurance income. So fee income was mainly from their wealth management fees, which was offset slightly by lower loan and trade-related fees, lower brokerage, as well as fund management fees. Their trading income also surged actually by 45% year-on-year to a quarterly high, and this was from record customer flow income and improved non-customer flow income. And their total wealth management for the first quarter, so this consists of banking and insurance wealth management income, grew by 19% year-on-year. Secondly, their net interest income was also up slightly by 4% year-on-year, and this was mainly led by a 5% increase in their average assets, which was offset slightly by their net interest margins, moderating 3 basis points to 2.27%. Their NIM moderation was mainly from higher funding costs, which offset the increase in asset yields. So as I mentioned earlier about when I was talking about UOB, how the banks manage their net interest income is by firstly putting in assets into the assets, their loans, they can put in the loans where they get loan yields, or they can also put these assets back into higher yielding interest. So that's how UOB has done, UOB and OCBC also has done it. So for their guidance for the NIMs and net interest income is to be at the higher end of 2.2 to 2.25% for the rest of the year, with their first quarter exit NIM currently at 2.27. So I think we are well on track to hit their guidance. For the negatives, the first negative is that their allowances was up 54% to 169%, mainly due to a rise in their specific provisions. So this rise in specific provisions was actually just to several accounts in ASEAN with no systemic risk and as well no concentration in any particular sector or geography. As a result, their total credit cost rose 4 basis points to 16 basis points. For their guidance for their credit cost is to be stable and to come in around 20 to 25 basis points. So it should probably come in at the lower end of this number if we are looking at the first quarter figures. For the last negative is that their expenses did rise 8% year-on-year, and this was mainly due to higher staff costs due to higher variable compensation associated with their income growth. But nonetheless, you look at their cost to income ratio, it was stable year-on-year at 37.1%. as the income growth outpaced the increase in their expenses. For the outlook, the loans grew 2% in the first quarter, and this is meeting the bank's guidance of low single digit for the full year. So they do expect some global growth slowdown, but they do see that ASEAN and Asia in general will perform better. And for the fee income, we are expecting a double-digit fee income of 12%, and this is mainly coming from the recovery in their investor sentiment. So as such, we do downgrade to accumulate, but with a higher target price of $15.40, and this is mainly the downgrade is mainly due to as we account for the recent share price performance, but we raise our target price as we increase the FY24 earnings by 2%. So we raise our earnings from a rise in our net interest income estimates from higher NIMs. So that's all I have for the results. I'll now move on to the next slide, which is what's in the news actually now. Currently, it's not the results, but it's their offer to privatize Great Eastern. So just some brief background on what this offer is. So they did a 1.4 billion voluntary unconditional general offer for the remaining 11.56% stake that they don't have in Great Eastern. So they currently hold around 88.4%, like that, around there. So their offer price indicates a value of $25.60 per share. So what does this mean for the people who hold GE? So if you look at their offer price, we use this several valuation multiples, but I think the main one that people or like analysts and everyone uses to value insurance companies would be the embedded value. So we do take the price over embedded value. So this offer price indicates 0.7 times price over embedded value. And we look at the 5-year average, it was only 0.54 times. So it's imputing a 30% premium to this 5-year average. And so for not just for investors, but for the OCBC stakeholders, what will it mean also if this offer goes through? It will add 0.2 percentage points to the group's ROE, so you increase it to 14%. And more importantly, it will actually lower their CET1 ratio by 0.6 percentage points to 15.3%. So this is a sort of spending some excess capital which they have. But even if they do spend this, they still have the higher CET1 ratio amongst all the 3 local banks. DBS is at 14.7% and UOB is at 13.9% as at the first quarter. Well, what does this mean? Because having a very high capital, it's a CET1 or capital ratio, they need to actually give this back to their shareholders or make acquisitions. So they have done this by trying to offer for Great Eastern, but they still have very high CET1. So it's potentially a direction where they could give back more dividends to shareholders to lower their CET1 ratio. So just as a comparison, I also put in the last couple of interesting privatization offers that happened in the last 2 years, mainly SPH, Boosted, as well as Danbing. So what does this show? It just shows that the initial offer is usually just the first offer where maybe these companies are sort of like testing water, right? And then the final offer is usually they will give it higher, as it goes up. So this doesn't indicate that or confirm, that OCBC will increase, but they have said that this offer is not final, and but they never said that they're going to raise the offer. So just take it at face value what they will say, what I said. So that's all I have for OCBC. I'll now move on to the next one I have, which is just a brief review and overview of the Singapore banks results. So for the Singapore banks, the 3 of them, the main highlight for this quarter was that their fee income actually provided the boost for their income growth. So you look at their NIMs, right? NIMs, all the NIMs were either up by 2 basis points, or actually most of them were down. So resultantly, the net interest income we're not seeing like double-digit growth anymore for net interest income. And I think moving forward, right, we could expect even a dip in net interest income for all the 3 banks. So currently only UOB has a slight dip at 2%, whereas the other 2 are still managing their assets, placing back into higher yielding interest. So that's why they can show this slight single-digit growth. So look at fee income. All 3 banks actually have shown strong fee income growth, mainly coming from their wealth management fee income. And resultantly, you look at their PATMI, they also have positive PATMI, despite what people think that their main business is their net interest income actually is not showing very strong growth. Yeah. And also, lastly, look at the CET1. You can see that OCBC, even before this acquisition or privatization, is extremely high, 16.2%. So they are trying to spend their capital a bit, by giving this offer of 1.4 billion. But if you look at it, they do still have quite a bit to go before they reach their range of, I think they said they're going to maintain it at a minimum of 14%. So even 15.3%, 1.3% higher than 14%, that imputes around maybe $2 to $3 billion, which they have excess capital they can spend. Yeah. So that's all I have for the Singapore banking sector. I'll now hand it over to Darren. Thank you.
Thanks, Glenn. Yeah, so I'll run through Prime BS REIT's first quarter update. Yeah, so the biggest thing for Prime is basically they need to refinance the loan, the 480 million loan. So that's about 69% of the total debt. Yeah, I'll go through more detail later. So yeah, for the results, basically it was in line with our estimates. So year on year is down about 8%, mainly due to lower occupancy. Occupancy now also about 80%. And as expected, the distributable income is down around 20% as well. It's mainly due to higher financing costs, finance expenses. Yeah, so we run through the positives. So leasing volume was actually doubled year on year in first quarter, but it's down quarter on quarter is down about 30-40%. So in the first quarter they signed 171k square foot of leases compared to 64k in first quarter. And during this quarter they signed the leases were renewed at as a cumulative minus 1.8 negative, or rather a 1 point negative rental reversion. So this is mainly because of the Western Square renewal. But if you take that out, the rental reversions were positive for the other leases. So this Western Square renewal basically is because the market rents are lower than the previous rents that the tenants were paying. And even after they renewed at negative rental reversions, the rents were still higher than market rents. Yeah, so for the negatives, basically they have 2 months left before they kind of default, or rather they have 2 months left to refinance this 480 million bond, not bond, a loan. And this is 69% of the total debt also. So the reasons why we think, or rather the management thinks that they will be able to refinance this loan is because, first of all, Prime is, the management, they are already in the final stages of securing the loan, that's according to them. The CEO is going to fly down to the US, Bank of America, to do the final discussions and do the documentation stage. So that's one. Another one is because the lenders are basically Bank of America. So this is different from the other peer REITs where that the lenders are Singapore banks. So for Bank of America, for instance, and other US banks, they are more comfortable with lending a US commercial real estate at a higher LTV and a lower ICR. So they are more comfortable, like for instance, for lending at about 65% loan to value as compared to Singapore's gearing level, which is about under 50%. And the ICR that they're comfortable with is also 1.5% as compared to Singapore's 2.5%. And lastly, Prime's assets that are still generating income and cash flows. So basically, because of these 3 reasons, management is very confident that they will be able to refinance this loan. But from our perspective, until it's done, we need to account for a bit of refinancing risk. So I'll talk about that in our valuations. So basically for them right now, they have about 79% of their debt, which is on fixed rate or hedged. And the all-in cost of debt will rose slightly to 4.1%. And their gearing is at 48.1%. So they are targeting to lower this gearing by executing about $100 million of deleveraging this year, and the ICR is about 2.9 times. One more thing to note is that for their debt, they've already hedged about 330 million of this 480 million to FY26. So basically, a portion of the debt that they're going to refinance has already been hedged. So they'll be relatively shielded from the higher spread and higher rates when they refinance. But we do expect the cost of debt to increase when they do refinance this loan. Yeah, and for another negative for them is that the portfolio occupancy basically is down. It's 80.9%. But that is because Sodexo, one of the previous top 3 tenants, they vacated One Washingtonian Center. So after they vacated, Prime decided to put this building under AEI. So right now, OWC is undergoing AEI, and if you exclude this AEI of OWC, the occupancy for Prime's portfolio is 84.7%. Yep. So going forward for the distributions, they have not committed to future distributions yet, so they'll manage it dynamically. Yeah. And their fiscal occupancy right now is at 60%. And they also noted that a lot of companies are mandating more of their employees to go back to work, but it still remains low. So the priorities for them is, of course, the first thing is their loan refinancing, and they also want to improve leasing and improve occupancy. And they also need to lower gearing. Right now, that they've not breached yet. 48.1% and ICR at 2.9% is still within the MAS limits, but they want to lower it to below 45%. Yeah, so with that, we downgrade to accumulate from a buy call, and we also lower our target price from 30 US cents to 12 cents, and we peg this to 0.2 times price to NAV. So 0.2 times price to NAV is which is in line with the peers, the price to NAV of the peers that they are trading currently. And we also tag this to 0.29 price to NAV to take into consideration the refinancing risk of the 2 months left that they have. And we think successful refinancing, it could narrow the discount to NAV to 0.3 times price to NAV, and that would result in a target price of 18 cents if they successfully refinance. So this 0.3 times price to NAV is basically one of the peers. Before they decided to halt dividends, they were trading at 0.3 times price to NAV. So that's why we use 0.3 times price to NAV for a situation where they could refinance the loan. So currently Prime is trading at 0.19 times price to NAV. And in our model, we assume a 25% payout ratio. So assuming that, the current forward yield for Prime would be about 9.5%. Yeah, so that's all for Prime. I'll move on to Manulife BS REIT. Philip on the ground, just a quick update on what's happening. Yeah, so for Manulife BS REIT, the occupancy, it dipped after one of the top tenants, TCW, left. And the rental reversions are negative 9.5, mainly due to two big leases, like Michelson and Plaza. However, they also noted that the net effective rents were higher than market rents. So there's a chart on the right which shows the capital management. And right now their aggregate leverage is at 56.7%. So they need to execute their recapitalization plan. So they noted that transaction volumes are still very slow, but there are signs of improving. Like year on year is up 20%, but that's from a very, very low base. Yep. And so what Manulife they need to do now is basically to achieve 230 million of net sales proceeds or divestment proceeds by 31st December 2024. So there is a timeline in the bottom chart there. We call it a chart, a figure rather. There's a timeline there. So by December 24, they need to dispose 230 million. If not, they will incur a fee. And this penalty fee is a complicated formula there, but basically the max penalty is 2.8 million. So it is not very significant considering the value, but it's still a penalty after all. And further down the road, they basically need to dispose about 230 million by 30 June. If not, they'll be in a default situation. So yeah, that's what they need to do. And yeah, basically the timeline it shows there, and by December 2025, the disposition mandate will expire and the covenant relaxation will end. And that is the bottom right chart is their loan maturity or their debt profile after the relaxation of the covenants and the extension of the loans. Yeah, so that's all I have for private Manulife. I'll hand over time to Zain to do TA. Thanks.
Thanks, Darren. I'll move on to the technicals. Next slide, please. Yeah. So looking at S&P 500 last week, it continues to trade higher, testing the ascending broadening wedge resistance. So for this week wise, we could see a slight pullback ahead from this resistance area, which is currently at 5,200 to 5,265, while the support is at 5,120 to 5,165 area. Next slide, please. So first up, we have a technical buy for Adobe at $486.18. Take profit levels at $522 and $550. Stop loss at $468, and the last closing price was $482.29. So looking at Adobe's chart, recently there was a breakout above a descending wedge, and then this followed after a double bottom formation at the $462 level. And then when we look at MACD and RSI, there was also bullish divergence and increasing momentum during the formation of double bottom as well. So with that, we could see the price continue to trend higher towards these two levels. Next slide. Then next one is on AMT. It's a technical buy at $150.60. Take profit levels at $162 and $172. Stop loss at $141. Stock last close at $151.92. So looking in terms of AMD's chart, recently there was a double bottom formed at around the $145 level, with bullish divergence in MACD and RSI as well. And then we also saw a fresh bullish crossover in terms of the MACD as well, which form a higher low. So with that, we could see the share price do a rebound towards these two levels. Next slide. So the next one is on Nanofilm, a technical buy at 69.5 cents. Take profit levels at 74 cents and 76.5 cents. Stop loss at 65.5 cents. The stock last close at 71 cents on Friday. So for Nanofilm chart, there was also a breakout above a downtrend resistance line. This was following a consolidation wedge that was formed recently as well. Also bullish divergence and increasing momentum on MACD RSI. So price could continue its momentum towards these two levels. Next one. Next slide. Yeah, so for Oracle, it's also a technical buy at $118.34. Take profit levels at $123.50 and $127.50. Stop loss at $113.50. The stock last close at $116.67 on Friday. So looking at Oracle's chart recently, it also broke out above a downtrend resistance line. This was following a main reversion pullback towards the uptrend support line in blue. Price also filled a gap over at the $114 level as well before a rebound took place. And then when we look at MACD and RSI, there was also a fresh bullish crossover as well as increasing momentum in the near term. So I think price could do some sort of rebound towards these two levels. Yeah. Next slide. Next one is a technical buy for SATS at $2.54. Take profit levels at $270 and $280. Stop loss at $247 and stock last close at $257 on Friday. So looking at SATS, there was after a very long period of pullback, there was a breakout above a downtrend channel. Also, price also managed to stand above the 253 prior resistance downturn support level as well, with bullish divergence and the increasing momentum recorded on MACD and RSI, while the stock was making a lower low in the downtrend channel. So we could see a recovery in the share price towards these two levels. Next slide, please. And then the last one is a technical buy for Pfizer at $28.27. Take profit levels at $28.90 and $30.10. Stop loss at $27 and last close was $28.01. So the take profit levels and stop loss level have been adjusted slightly lower to account for the XT that took place after the technical call was made. And so looking at Pfizer's chart, there was a breakout above a descending triangle resistance. And then price did a back test of the trend line before it went higher, with bullish divergence and increasing momentum previously when it formed a double bottom at around the $25.20 level. So we could see a recovery in terms of the share price towards these two levels. Next slide. So just a summary of all the trades initiated just now. Adobe is currently down about 0.8%. AMD is up about 0.8%. Nanofilm up about 2.1%. Aerocle that is down about 1.4%. SETS up about 1.1%. And for Pfizer is currently down about minus 0.9%. So that's all from me. I'll hand over time to Jonathan to talk about Mag 7 monthly. Thank you.
Thanks, Shane. And morning, everyone. So I'll just run through our Mag 7 for April. In terms of the performance, the Mag 7 was down 2.9%, which wasn't great, but relative to the major indices like the S&P 500 and Nasdaq, which were both down more than 4%. I guess it was a little bit better. In terms of the individual components, Alphabet or Google was the biggest gainer, up 7%, while Meta was the biggest laggard, down 12%. This is quite interesting because both these companies had pretty good earnings, and they also are in the same advertising industry. Next slide. So just a brief, summary of all the results. You can see as a group of companies, the Mag 7 grew about 9% year-on-year in terms of revenue, which was a slight deceleration from last quarter, mainly because it was dragged down by Alphabet and Tesla, which both declined year-on-year. In terms of earnings growth also declined a little bit, but it was still up 37% year-on-year, so quite significant gains. You can see here most of the gains coming from Meta, Amazon, and Alphabet, about 50, 100, and 200%. Very significant gains there. In terms of guidance for this upcoming quarter, it's a little bit muted. Expect growth to remain around the 9-10% range. Mainly because at least for the digital advertising companies, they did mention that there'll be a little bit tougher comps in the second quarter of this year. Because in the second quarter of last year, they started to see an increase in demand from the Chinese outbound. And that's basically, it wasn't there before the second quarter of 2023 because China was still kind of, I won't say in lockdown, but they're very inward facing. And they were starting to recover. So this has already been happening for, I guess, a year or 4 quarters. And as you let a period of stronger growth, naturally your growth rates come down. That being said, if you just take a look at the absolute numbers, it's continuing to increase. Something that was also quite interesting is that we're starting to see the price of share buybacks increasing. First quarter alone, this is excluding Nvidia because Nvidia announces its earnings next week. Share buybacks of about close to $60 billion in the first quarter, and over the last 12 months they almost hit $200 billion US dollars. So it's a large amount of money. We take a look at the pandemic peak share buybacks, and this was when there was a lot of, it was basically boomtown Charlie for most of these big tech companies. A lot of cash flows, a lot of operating leverage, and they did about 210 billion in terms of share buybacks. So we're very close to that. Basically, just trying to show strength for a lot of your Mag 7 companies in terms of how much cash they have to deliver these returns back to shareholders. Next slide, please. Just for comparison, like the share buybacks of 220 billion is essentially like half your STI. So half the market cap of the STI. Next slide, please. Another interesting thing we are seeing is cloud growth is continuing to accelerate after the bottom in the second quarter of last year. So it's actually we're trying to see how much of the demand is coming from AI and whether there's actually a tangible demand and how quick this would actually accelerate. How quick this would accelerate revenue growth for cloud. And so what we essentially are starting to see, and what we've seen for the last couple of quarters, is that revenue growth, which is the line here in orange, starting to pick up. It's slightly over 20% year-on-year for the quarter. At the low point, it's about 15%. And it's actually, when you look at the blue bars, that's just your last 12 months. That's just your cloud revenue over a quarter. It continues to just trend upwards quarter on quarter. So growth is picking up, and they continue to make all-time highs in terms of cloud revenue. mainly because what you're seeing is they're starting to monetize it a little bit better. They're raising their prices, and so you're seeing average revenue per users go up. You're seeing this sort of resumption and transition for a lot of corporate spending from on-premise to off-premise as they transition to be more, I guess, your digital transformations and all that. And then you're also starting to see a lot of demand from AI, and this is flowing through to hyperscalers like Amazon, Microsoft, and Google. So very strong tailwinds for cloud, at least the overall cloud industry. We're expecting this to continue moving forward. Next slide, please. Yeah, in terms of the individual counter updates, we'll go through Alphabet and Meta. Mainly your digital advertising guys, like I mentioned earlier, the first quarter results were quite good. Starting to see this sustained growth in terms of digital advertising dollars. A big part of it is because of your AI-related content and AI-related efficiencies that are driving better products for advertisers. Driving higher ROI, higher eyeballs. So because a lot of how it works for advertising is that there are two main systems. One is there's a fixed price for I guess your ad locations on the space, and then secondly, there's a more dynamic pricing system for most of the ads where it's just a bid-ask system. So it's really just a marketplace where advertisers, if they really want a particular space or if they really want a targeted, more targeted advertisement, they just got to keep paying higher prices. And as long as the performance for these ads continue to improve, then these corporates and these advertisers are willing to pay higher prices. The big knock for both these companies, or at least for Meta, which is really what impacted the share prices. Firstly, they guided to lower growth, which is kind of expected. Secondly, they increased their capex while also mentioning that they're going to be spending, continuing to invest heavily in its reality lab segment, which has been losing a lot of money. So analysts, or at least investors, weren't really too thrilled about that because you unlike Google, where you've got basically all three segments growing, for Meta, you've got one that's really lagging behind. It's not really maximizing the full potential of, I guess, near-term operations. That was a big knock in terms of capex. But it also goes to show that a lot of these big companies are spending more and more money on their doubling down on their AI capabilities, and that's I guess flowing through to a lot of your hyperscalers. The other news for both of these companies is that they announced their latest custom-made chips. So most of your big tech guys now are producing their own custom-made accelerated chips for AI. Not really GPU per se, but more on the CPU and SoC system. So in some sense, they are trying to compete, or at least reduce the reliance on NVIDIA and AMD and Intel for AI chips. That they're able to make their own custom-made chips that are not just custom-made, but more customizable in terms of usage that fits their purpose a little bit better. And so a lot of your big tech guys are spending money and actually developing their own in-house chips, which I guess is a good sign for the overall semiconductor industry. Maybe not so good for the current incumbents, although we do expect that because the volumes for these in-house chips are relatively low, it's not like they're going to overhaul their whole supply chain and not buy any more NVIDIA or AMD or Intel chips. It's just kind of to supplement it with their own. Moving on to NVIDIA, they acquired two Israeli startups aimed at, and these Israeli startups they really, their main purpose is to lower the cost of creating and running AI models. Nowadays, with AI being front and center, there's a lot of models that are being run, so the workload is constantly increasing. And what a lot of these companies are seeing is that with increasing workloads, it takes more computing power, more energy. So it's costing a lot more money for them to run these models. And what I guess NVIDIA is trying to do here by acquiring these two startups is to try and reduce I guess the cost to run these models, because it's going to be a long-term thing. Hopefully that will help margins move forward, even if it is by just 10 basis points. At least there is some sort of improvement in cost efficiency there. Moving to Tesla, Tesla really had a poor quarter. They missed delivery expectations. They also missed their results. Revenue expectations mainly due to a decline in both volume as well as prices. So overall, not a great quarter for Tesla. The only shining light is that they reached a mapping plan agreement with Baidu, which is one of China's largest search engines and all that. So they made an agreement with them to gain access to Baidu's mapping system. So just in case you didn't know, you can't really use like Google Maps or any other maps in China except for their own local systems. And so without this data, it's very difficult for Tesla to roll out its FSD system or FSD program in China because you just don't have the data. You don't have the maps to navigate. You don't have enough data collection to run your models. And so this agreement is quite big because in China, all driving assisted systems or ADAS requires a mapping service license before operating. And the only way you can get a mapping service license is to partner with a local Chinese company like Baidu, because only the Chinese companies have this. So that was kind of a stumbling block in terms of FSD rollout for Tesla in China. And now, at least with this agreement, there is a clearer path to developing FSD. It's good long term, although it's still a bit too early to say how this will benefit, or at least the how large of the impact this would have on overall revenues and margins for Tesla. So that's all for my counters. I'll hand it back to Helena and Ambrish to wrap up the Mag 7. Thank you.
Thank you, John. Moving on to Apple, we just shared about Apple's earning results, so I'm not going to repeat that. So Apple was ranked second in global market global smartphone market, and third in China smartphone market. So in the global market, it has a decreased global market share of 16% compared to Samsung's 20%. And in China, it's facing a lot of competition from local rivals, Honor and Huawei. So Apple's share is 15.6% market, while Honor and Huawei both secure a 17% market share. So the competition is very intense in China. So but despite some patience is required to navigate this China weakness, we still feel that Apple might have the chance to gain future growth. But now, because they haven't revealed anything about AI yet, so we're a little bit uncertain. So we remain our target price at $194. Moving on to Amazon. Amazon's first quarter earnings were on the high side of estimate, with 12.5% year-on-year growth, driven by strong growth in AWS and advertising. They also continue reaping the benefit of regionalizing its operations and bringing down its cost structure further. So this drives their operating margin and operating income to an all-time high. They have guided for 7 to 11% year-on-year growth for their third quarter. So this is kind of signaling a potential pullback in consumer spending. AWS plans to spend another $11 billion on data center in Indiana. So this is going to increase their total investment in Indiana to $21.5 billion. So Amazon did mention that they see a lot of growth potential in AWS. So they will now start to increase their capital expenditure tremendously in 2024. So this is obviously them starting to increase their capital expenditure, and we're going to be seeing more of that in the future. Last but not least, Amazon rolled out affordable grocery delivery subscription service for Prime members in the US, aiming to expand into fresh food business. So the subscription offers unlimited grocery deliveries for $9.99 per month on orders over $35. So this is available in over 3.5K cities and towns nationwide. So we do see that Amazon, they're still actively coming up with new ways to monetize their business, including the Prime Video, and then the medication subscription that they aim to deliver within 1 day. So we do think that Amazon, they have sustained effort in enhancing their efficiency and also specifically in ways to increase their margin. Additionally, we do see positive indicators of reacceleration in AWS and increased investment in the sector. So we do we do maintain being quite bullish on Amazon. We maintain a buy rating with a raised target price of $220. Okay, that's all from me. I'll pass my time to Ambrish to talk about Microsoft.
Thank you, Helena. So moving on to Microsoft, in April, it had reported its third quarter results, which were generally in line with our expectations. So for Microsoft, the total revenue grew by about 17% year over year. And this was mainly because of strong demand for its cloud service, Azure, which grew its revenue by about 31% year over year. And this was mainly because of the shift in workloads, our data from on-premises to the clouds. And also the company, it's witnessed recovery in its Windows segment, mainly because of recovery in PC shipments. And its gaming segment revenue also surged by about 50%. And this was mainly because of the Activision Blizzard acquisition. And moving on to the bottom line, its PATMI grew by about 20% year over year. And this was mainly because of high operating leverage. So in terms of outlook for this quarter, it expects a revenue growth of about 14%, and it would be continued to be led by growth in Azure, which should grow by about 31% year over year. And it's spending significantly to build out the AI and the data center infrastructure. And as a result, its capital expenditures have been increasing year on year. And despite this, for this quarter, it expects its operating margins to remain flat at 42%. And overall, for Microsoft, we have an accumulated recommendation and a target price of $465. So to conclude, for Magnificent 7, there has been a weak demand for iPhone sales as well as electric vehicles. And despite this, we maintain our overweight recommendation mainly because there has been strong AI-related demand, and also digital ad pricing has been picking up, and the cloud, there has been the recovery in cloud as well. So and also in the second half of 2024, we could see a boost in PC shipment sales, and also mainly because of the potential upgrade cycle, mainly because of the launch of AI personal computers. So we maintain overweight on Magnificent 7. So that's all for me. I would now like to pass it on to Jonathan.
Yeah, thanks, Ambrish. So I'll run through our Singapore weekly. Sorry. Before that, I'll just run through PRC Asia. Yeah, this was actually covered by Paul. Just presenting on his behalf. Thanks, Ambrish. So overall, results were actually pretty good, within expectations. But when you look at your earnings, jump almost 50%. Mainly due to recovery in top line. They saw, I believe it was like a 6% recovery in 6% recovery in revenue over the last quarter, which was actually over the first half of 2023, which was a little bit weak because there were some disruptions from workplace safety. There were quite a lot of accidents, and so the government was clamping down quite significantly on a lot of construction sites. This was really further dampening construction volume. On the second positive is that gross margins started to normalize. There was a little bit of, I guess, decline in the raw material prices, which was good. And also, typically, as revenue starts to accelerate a little bit, you start to see gross margin expand a little bit because, it's just, it is a higher margin, I guess, some sort of operating leverage there. But I think it's maybe due to a little bit of a decline in your raw material prices. In terms of the negatives, the company did actually mention that there were some constraints in terms of the project delivery because of manpower issues. They weren't even able to find, people to I guess, design the blueprints and even from a worker shortage perspective. So these were the main negatives for PRC. In terms of their outlook, so in terms of valuation, we actually maintain our earnings for 2024, but we raised our target price to $2.57, up from $1.98, mainly because we increased our growth rate assumptions slightly. When you look at looking forward, in terms of the construction demand, right now we're seeing an average range of about $35 billion US. And when you look at per annum, but when you look at the pre-pandemic average, it was about 28 billion. So there still is a significant jump, about 25% jump in terms of construction demand. Obviously, the big one that everyone's looking out for is the Changi Airport Terminal 5's a project that should be underway next year. So that'll be another boost to orders for next year as well. So we maintain a accumulate on BRC Asia. With that, I'll go into our Singapore strategy of Singapore weekly. Next slide, please. Yeah, so overall on the macro front, really not much to talk about. Big thing is obviously your arrivals continue to expand a little bit, 20% year on year for April. It goes to show that even post Taylor Swift, there is still growth for arrivals in Singapore. Actually help to continue to benefit the hospitality sector, hotels, restaurants, bars, even transportation like SIA and SETS. In the US, not much. Just your bank loans started to expand a little bit. 7 months of decline, so you're starting to see a bit of loosening. I guess at least a bit of growth in terms of bank loans, which is good because it kind of gives you an indication that the economy is starting to expand a little bit. Next slide, please. For our tactical views, like I mentioned earlier just now, big tech is still really the best growth option that you can find out there. You look at earnings up 37%. And this is excluding NVIDIA. So if you include NVIDIA, probably close to 50% at least. Or at least 40+%. And it's you can't really find this in any of your sectors in Singapore or any individual company even. Like I mentioned earlier, most of it coming from your increase in cloud spending, digital marketing, as well as your share buybacks, which is quite an important point, especially when your numbers start to get up in the hundreds of billions, significant amounts of share buybacks for a lot of these big tech. The second that we're looking at is the AI boost. When you look at TSMC's revenue, it's up quite significantly, 60% year on year in April, and it's second highest on record. It's a bit lumpy there because last year was pretty bad. But when you move that and you take the comps versus April of 2022, it's still up almost 40%. So still a significant gain. Obviously, another thing we're seeing from the AI boost is cloud capex, which I showed earlier. Oh no, I didn't show it. Sorry. But we did a computation of capex spending of a lot of big tech companies. We found that cloud capex is up about 40% year on year for the first quarter of this year. So they are spending close to $50 billion a quarter. And when you look at Meta and Google, they also raised their capex guidance by about 10 to 20% for the full year, right? So you still expect more cloud capex spending to continue. Although it's not really that clear on the ROI for any AI investment just yet. When you listen to a lot of their calls, they talk about it's very big picture, very macro, very long term, very difficult to quantify, right? In terms of the events happening this week, we have ST Engineering earnings, then we've got ComfortDelGro, StarHub, and Titan. Next slide, please. So I'll just run through some of the Philip on the ground for this week. So first one is AEM. So actually AEM had quite a bad set of earnings here. Profit was down, I guess almost 90% year. It's quite bad. And the main reason we're seeing, well, obviously one of the biggest reasons is because revenue is down quite significantly. It's quite interesting that in terms of guidance, they didn't actually change any guidance for the first half of 2024. So if you're taking a midpoint of their 170 million to 200 million in guidance, essentially they are guiding to more revenue downside for essentially a 25% year-on-year decline in revenue for this quarter that we're in right now. So it's not really, doesn't really give investors that much confidence. At the same time, when we look at some of their customers, one of the biggest customers is Intel. Also not really giving them much orders because utilization rates are still actually very low. So they're not really seeing any follow through from growth in their customers per se. Yeah, so not really I guess a good set of earnings for AEM, and kind of saw it a little bit in the share price. Yeah. One thing they did announce that they had 5 new customers, right? And one that is under evaluation. And this should help to bring triple-digit millions orders in 2025, which is a bit vague. So I'm not really sure what that means. But when you look at, they did mention that they had one new AI customer, and we suspect that it's actually going to be AMD. Although it's quite clear that the initial volumes will be quite thin, so it wouldn't really affect revenue in the mid. Yeah. So the key growth driver for AEM, everyone knows, is AI chips are moving to the edge, so they're trying to have AI chips in your phone, in your PCs to do all your inferencing and training workloads, which is essentially what all the major semicon companies are talking about right now. Yeah. So yeah, I mean that's all for AEM. Near-term outlook not really that great, but recovery in the second half are a little bit more possible. Next slide, please. Yeah, so my next company will be Riverstone. They're a rubber glove maker, I guess similar to Top Glove. They did actually very well, so their earnings were up 50%. Again, it was quite significant. And they also announced a quarterly dividend because they got too much cash, which is I guess a good thing to have. Utilization rates are still fairly high, and the industry is actually improving as well. So they're seeing a lot of their customers restocking after inventory was depleted, post-pandemic, after there was such significant hoarding. So yeah, in terms of their outlook, demand still looks to be growing, in a good position to capture all of this demand. So that's all for Riverstone. Last slide be on SingPost. In terms of their second half results, operationally quite flat. It's only up about 2%. So not much to do there. The big thing for SingPost is that they do have quite significant excess capacity in terms of their warehouse in Australia. So over the pandemic, there was a lot of building of warehouses to fulfill all of your e-commerce, your logistics, orders. And since everything's opened up, they're now seeing that there's so much excess capacity there. I guess on the bright side, SingPost still is planning to dispose of some of their non-core businesses, like their SingPost Center, which is almost $1 billion US. The 900 million versus their market cap of $1 billion. So this, and they're also reviewing their postal business quite significantly. So if they do happen to divest, I guess it'd be beneficial in terms of a cash flow perspective, maybe return some value to shareholders. Yeah, so that's all for the rest of for Paul's slides. I think we can just get to Q&A for now. Thank you.
Yeah, maybe I'll just take on the one about GE and OCBC. So someone asked, I think BY asked, hi Glenn, is the acquisition of GE by OCBC in the interest of OCBC's shareholders? So I'm guessing, how are they going to make this acquisition earnings accretive, I guess, for the bank? And in the long run also, how will it improve, I guess, dividends and also their bottom line, right? So I think that's the main crux of the question you're asking. Okay, that's a very interesting question, because we also asked the CEO, and the board, the directors, so the management, why are they doing this now, and how will it affect the bank, or how will it improve the bank, more or less. So firstly, they said, they gave all the figures like I showed earlier, how it will potentially increase the ROE by 0.2%. And then, they're also saying that it's going to spend some of their excess capital, which they do have plenty of, and they're using cash as well. So but apart from that, not much is said, but what we can draw from the conversations we had during the briefing is that they'll be able to better synergize GE with OCBC. So currently, while they do have the majority shareholder, 88%, they own, I think they more or less own it. but I think they're facing a lot of headwinds in terms of some pushback from the shareholders, minority shareholders, which is what happened in the last few months. We saw they had some disagreements on certain things, and also with this, when they have full control over GE, they may be able to better improve cross products selling, and it could also potentially increase their wealth management fee income on OCBC side and GE side. So it's really very hard to say how would they make it better, how would they synergize it better if this does go through and they do delist it and make it fully into OCBC Group. Yeah, so it's really a lot of ifs for us. But I think if you look at the figures wise, for the shareholder, I think an OCBC shareholder will probably be asking, why can't they just give this back in dividends instead of buying out the rest of the 11%? Because it doesn't really make a very significant difference. They're not buying something new like what UOB and DBS did with the City assets, right? They bought something new and they managed to expand into different regions, which they probably were not, I would say, very. Their market share wasn't very big, but with the City acquisitions, they grew, right? And why don't they do something like that? So to them, what we could draw from the conversations is that they are looking to get something where it's very low risk, right? So GE is already integrated into OCBC, right? They have very low risk of acquisition. So if they were to buy out the rest, it'd be very easy to sort of transfer everything over and then synergize the whole company as a one group, right? If they get something new or something that's very big, at that 1.4 billion price, then they might not, it's a risk, right? Also, whether or not they are able to fully integrate that new company into the bank, into the group. So that was one of the reasons. And also, they said that this is probably the right time. Of course, they said it's not because of a quote. They said it's not going to be because of what will happen with the minority shareholders, right? So let's put that aside. Yeah. Apart from that, the dividends wise, they are still highest CET1 amongst the three banks. That's a good sign for shareholders because it means the OCBC will probably have to do something else, to lower it. I think it was mentioned the optimal CET1 they're going to maintain is 14%. 15.3% is quite a fair bit away from that 14%. Also, if you add on the new Basel requirements, it could add possibly 100 to 150 basis points. So, it could even be hit 16%, right? So they do need to lower it down. And I think there's a possibility we might see, hopefully in the second half, but if not, we could see some indication of how much they're going to increase and whether or not they're even going to increase their dividends by year end, at least, hopefully for OCBC. Yeah. So that's all I have for that question. I'll hand it over to the rest of my colleagues. Thank you.
Yeah, thanks, Tim. I'll take this question real quick. It's on UMS. Quite a number of questions on UMS. So they just actually announced their earnings. We just had attended their analyst briefing for their earnings earlier on today. Yeah, so I'll just read out the questions. Firstly is what happened to UMS today? And then in view of the big drop in earnings for first quarter UMS, is it now the light at the end of the tunnel or is it still far? So essentially what happened was earnings, well, revenue was quite bad, down 40%, 33% year. And then earnings also down almost 50%. Really not that great. In terms of why, so what, and not just UMS, but most of the Singapore semiconductor companies they're not really seeing a flow through from demand from their customers. So their customers like Intel, whoever, they're saying that they're very optimistic on outlook because they expect this upgrading cycle to happen. So they're planning, they're gearing up for more production and all that. But this doesn't really seem to flow through to a lot of the Singapore companies for whatever reason. I think maybe because of where we are in terms of the overall semiconductor chain. It's more your testing and precision engineering. At the same time, utilization rates are still actually very low. So even if they ramp, if they want to you mentioned utilization right now is at 30%, and the customers want to ramp up their production like 3x. There still is, we still have a lot of utilization capabilities to fulfill it. It doesn't necessarily translate to a lot more revenue. And then on the second hand, we're not really seeing a lot of volume come through. So when a lot of their customers talk about being very optimistic, it comes from a revenue growth perspective, and that's because a lot of these AI products are higher in revenue, but they're lower in volume. So for a lot of Singapore guys, they thrive on more volume, but so far we haven't really seen any volume come through. You just take UMS for example. Their biggest customer, which essentially is Applied Materials. They said that 2024 demand from Applied Materials is still going to be flat compared to last year, which is not a good sign because last year was really bad. And AMAT is guiding for a much better, slightly better 2024. And then when you look at the near-term challenges for UMS, there's still quite a little bit of inventory overhang, especially from some of your Asian electronic manufacturers. At the same time, they're still seeing a little bit of inflation pressures driving at OPEX. Those are really not. They just don't see the direct flow from revenue growth for a lot from their customers, which is what I'm trying to say. So guidance also wasn't really that great. It did mention that 2024 growth really, if any, it's going to come from their new customer, which is Lam Research. So they set up a new factory in Penang. But like most things, when you set up a new factory and start ramping, initially the volumes are not going to be very high. At the same time, the revenue that's coming from there will come from the components instead of the integrated systems. So just a bit of backstory for integrated systems for UMS. Usually how they charge is how it's priced is based on a 3-year contract. So you kind of have this fixed recurring revenue for 3 years. Whereas for components, it's just as and when ad hoc, whenever the volumes come in, and price it on a tiered system. So it's a little bit different in that sense, where you don't have that I guess safety net of constant revenue coming in. So all in all, local semiconductor industry still, I don't think it's tough to say that there's light at the end of the tunnel, or you're seeing any light at the end of the tunnel, because guidance for this coming quarter is still not really great. Also, they're sounding a little bit more bearish in terms of recovery. In terms of maybe a recovery in the third quarter, maybe this will be pushed into the fourth quarter or next year instead. So overall, that's kind of why there was you're seeing a really big decline in share price for a lot of the local semiconductor guys. Hope that helps. I'll pass it on to the rest of my colleagues. Thanks.
Thank you, John. So
Yeah, go ahead.
thank you. So there was one question with respect to Square. So revenue growth pretty significant, turned profit as well, outlook positive, but why its share price has not been performing? So we believe that there could be mainly two reasons that the investors are cautious right now. First of all, the companies it has been increasing its investments into Bitcoin. So they had made a Bitcoin investment of about $200 million a couple of years back, and it's worth 600 million right now. And in the most recent earnings call, they said that they would increase each quarter, whatever the Bitcoin profits they have generated, they would invest 10% of that into purchasing Bitcoins. And in the previous quarters, they used to make a purchase of about 3%. So they have been increasing investments into Bitcoin. This could be one of the reasons. And the second reason could be the allegations that have been surrounding the company. Like last year, the Hindenburg short seller, Hindenburg Research had issued a short report on the Blockstock. Whereas a couple of weeks back, NBC also had issued a report that it's former employees, they have alleged the company that it has been there have been like compliance lapses and also no effective procedures for to know their customers. But as of now, the company, it has denied any allegations right now, and they have said that there are no investigations ongoing right now on the company. And also they have it has a robust compliance right now, and they onboard the users after verifying their social security numbers. So it said that it does have procedures in place right now. And yeah, we will track any further developments on potential developments on these allegations, if any. So there was another question with respect to Magnificent 7. So your Magnificent 7 updated show update as of 7th of April. So why early April? So we basically have updated our Magnificent 7 as of May 8. So sorry for the confusion. I guess it's mainly you read it as the title of the slide was Magnificent 7 April 2024. So it was for the month of April, but we have updated our slides as of May 8. Hope that helps. So would like to pass it on to the rest of the team. Thank you.
Hi, I'll take the Lendlease question. For Lendlease rate, would we concern about the high gearing in the view of high interest rate for longer? Is there a lot of debt to be refinancing FY24? So there's no refinancing risk in FY24, but there's a 315 million financing due in FY25. And although the rate could be higher for longer, but we don't expect any major change in valuation. For Lendlease, Singapore side will remain resilient, given the high occupancy rate and a very strong rental reversion. But Milan side probably will see some drop back, as one of the building need to be backfilled. But the overall valuation for Milan doesn't really account a lot. The valuation for Milan complex is only around like 12% of the total valuation of the portfolio. So gearing won't be affect much at the year-end valuation. And the next one, what is the adjusted interest coverage ratio? Any comment on that aligned to the market expectation? So ICR is 3.4 times. They didn't disclose the adjusted ICR this quarter as like there's no financials provided this quarter. At the current level, their gearing is kept at 50%. So although the market generally penalizes REITs with gearing over 40%, but L-REIT mentioned that they are comfortable with the gearing at the current level. And we don't expect any risk of further major increase in gearing. But they also mentioned they don't have any divestment plan at this point of time because like valuation for Singapore side is very high. So buyers' interest are more of the distressed asset. But asset for L-REIT are all doing very well. So although there's like they do see some interest from the market, but the price didn't really meet their expectation. So we don't expect there's going to be a big change in their gearing. And for ICR have decreased by 26.9%. Why, and is there any concern? What is the reason for the delay in the construction of Live Nation? A formula for ICR is EBIT divided by the interest expense during the period. So it essentially just because their interest expense has been continued increasing. So that's why ICR decreased. And delay in Live Nation is because like post-COVID, there's like manpower shortage and there's some supply chain disruption post-COVID, especially during the Russia crisis. And it just prolonged the whole process. And currently they are doing the cost budgeting and they are also on the stage of applying some license and regulatory approval. Yeah, so they probably need more time. Will complete by second half 2025. Yeah, as they last updated. Yeah, hope it answers your question. I'll hand over to the rest of my colleagues. Thank you.
Hello. I don't know whether you can hear me because my video is not loading. Anyways, okay, I'll answer the question on Apple. So Apple seems really quiet on its involvement in AI. Has it actually invested CapEx in AI development, which may allow us to see some potential results later on? The short answer is no. I mean, Apple has never been huge on spending CapEx. So their CapEx for the last quarter is around 2 billion, which is around 2% of their revenue. So you cannot really compare it with those tech peers like Amazon. They invest around 15 billion, which is around 10% of their revenue. So it's pretty low investment for Apple. Even compared with their previous quarter, there's actually a small dip in their caps. Previously, it was slightly above 2 billion. The last quarter is slightly lower than 2 billion. But I guess we should wait and see 1 month later what review do they have for us, and we see how. I hope that answers your question. Pass my time to my colleague.
Okay, thanks. Let me take on some. There's this burning question. What's the difference between accumulate and buy recommendation, and what's the time horizon? Yeah, so for all our recommendations, we have a 1 year time horizon, and the difference between accumulate and buy is basically if the total return, which includes dividend, if it's between 5% and 20%, it is an accumulate call. It is a buy call if it is more than 20%. Yeah, so hope that clears it. Yeah, okay. Yeah, what's the latest update on Keppel DC REIT? Yeah, so there's no update since the first quarter 24 results. I mean, yeah, since then there's no new developments. So basically, the thing that's happening with them is that they're still not collecting rent from their China Guangdong data center tenant, Neo Telemedia, or Blue Sea rather. And the rent that they owed cumulative is about 8 months already, 8.5 months. Yeah, so sooner or later, we think they will have to kick them out and they have to find a new tenant, and then we have some downtime for the China property. So the China asset accounts for about 7 to 8% of revenue. Yeah, around 7% of revenue of the full year revenue. Yeah, so that will continue to affect Keppel DC, but generally they're other than the China portfolio, their portfolio is still quite resilient with high occupancy about 98%. Yeah, that is the 98% is including the China data center because they are still occupied, they're still operating, just that they are not paying the rents. On Prime, if the refinancing in July is not does not pull through with Bank of America, can you share what's the implication and what are the backup plans? Yeah, so if they do not pull through that loan, they'll likely be in a default situation where the banks can request to collect back all the other loans, not only the 480, but the remaining as well, the outstanding. So regarding their backup plans, yeah, I'm not too clear their backup plans because when I spoke to them, they seem very confident that they will be able to do it. And yeah, we just have to wait and see because they did mention that they are likely to complete the refinancing by June. So that is in a month's time. Yeah, but regarding the backup plans, yeah, I'm not sure also, to be honest. Yeah. Do you think iREIT still have potential to go back to 70 cents? That will take some time, especially since there are still some headwinds in the portfolio. Like one of the big tenants will be vacating by the end of this year, and they're still hit by higher interest costs. So in the near term, I don't see it likely to go back to 70 cents. as there are a lot of headwinds that are still in the portfolio, like occupancy wise, and as well as high interest rates. So yeah, it's unlikely that they'll go back to 70 cents in the near term. ESR, the Hong Kong listed company might be going private. Yeah, and how will this affect ESR Logos REIT? Yeah, I don't see any immediate impact to ESR Logos REIT, even though they are the sponsor. Yeah, I don't see much impact. What percentage do China assets account for total revenue? Yeah, it's about 7%. Over total assets is around 12%, but over total revenue is around 7 to 8%. And is it better to buy fund manager like Capital Land Investments or versus Capital Land Commercial Trust at this timing for 2-year period? Yeah, so both have been trading at quite depressed prices, but basically if you are in it for the yield, I would recommend Capital Land CICT. The parent CLI is trading at steep discount to its RNAV as well, or rather to its sum of the parts calculation internally. So we think there is potential for some share price appreciation for CLI. But for CLI, it'll take some time because they're also affected by high interest rates. And for them to actually start deploying money, it'll be easier for them if interest rates have, or rather the outlook is more stable where perhaps interest rates are coming down, and then deploying money will be easier. Raising capital will be easier as well. So yeah, so basically, if you're in it for capital appreciation, I would say CLI would be a better pick because they're trading at a big discount now. I think that answers that. Yeah, okay, I think I can hand over the time to Zain now for TA. Yep, Zain, please. Thanks.
Sorry. I still have one more before this. Let me answer this real quick. Yeah, hi John. For your presentation on AM just now, can I deduce that it's still not the right time to go in as yet? That is fundamentally. Yeah. So, short answer is yes, you're correct. Long answer is there's still quite a lot of uncertainty in terms of how they get their how the revenue flow through to them, and at the same time, there's a lot of competition in that space. So it's not like they are the monopoly in terms of engineering and testing. So you've got incumbents like Advantest and Paradigm that are really challenging you for all of the volume. You look at a company like UMS as well, you get market share or at least in terms of their volume, they're losing market share to their competitor in Penang. So it's just kind of a difficult time for not just AM but most of the semiconductors here because volumes are not really flowing through. Utilization is still low, and there's still quite a bit of competition. That is coming in, or at least from existing incumbents or existing players. So if there's no real clear line of sight in terms of recovery, general recovery, then it's a bit difficult to say when will come in. But definitely in the immediate term doesn't really that good. Yeah, I hope that helps. Okay, that's all for me. I'll hand it over to Zain to do some of it.
Okay, thanks, Jordan. I'll share my screen now. Yeah, so first question is on AEM. What's a good entry price? Okay, I think looking in terms of the chart wise, based on the previous times when it was a gap down post earnings, I think it has a good entry price will be quite some time after because tends to decline quite a bit before it starts to sideways and then to turn upwards. So you see back in February last year, there was a there's this decline over here. Then price started sideways before going upwards. Then another time was start of this year. Then there was a big decline before a bounce and then it came down again. So I think currently it's still quite fresh in this decline. I think it could still possibly go lower towards maybe like 160 if it does retest this trend line over here. And then 160 is also a previous horizontal level, close to a high made in 2018 last previously. So I think for now it's still better to wait and see first for the price to stabilize first till it forms some sort of sideways. Then there's a chance for a rebound upwards. Yeah. Okay, then the next one is on OCBC. Okay, for OCBC, I think it's still trending quite well. On Friday, there was after the results, there was a break above this $14 level and still continue to go upwards. So I think nothing has changed in terms of the trend wise. Some short-term resistance could be around the $14, around $14.35 over there when it does retest this trend line over here. But I think overall it's still okay. It's still trending well. Yeah, continuing in this uptrend. Next one is on 1038 Hong, which is CK Infrastructure Holdings. I think for this counter, there could still be some potential upside ahead. Given that price previously came back down to retest this $42 level, and then afterwards subsequently it did a consolidation over here between $44 to $45, and it was this support breakdown, managed to recover back above it. Currently is retesting resistance at around 47 over here. So I think we could see some sideways consolidation over here, but I think you should be able to see some further upside ahead with the recent momentum. Yeah. Okay, then next one is on ARM. Okay, for ARM, I think short-term wise, I think there still be some upside. So after a range consolidation, there was a break above the $103 level, and then price did a retest after the earnings, recover back upwards. Then after that, I think with that, should be continuation of upside towards like 117 to 121 area, which was this support level breakdown previously. Yeah, so we should be able to see a retest over here. Okay, then for TSM, I think it's looking positive as well. Price has been trending along this uptrend support line, and then on Friday there was a gap up above the resistance at 146. So with that, I think price could still continue on its momentum towards the previous resistance level, like close to 150 to 153, then followed by 157, 158. Okay, then for NVIDIA, I think it's currently doing a bit of a sideways consolidation at a prior resistance level around the 905, 900 to 920 area. So I think for now we will see some consolidation continue, but the current trend wise is still trading this uptrend channel. So there could be still some further upside you can make if you can break above the current consolidation. Yeah, then support is at this recent swing high level, which is around 880. And as for Apple, Apple after the earnings gap up here, it has just traded sideways. Still some resistance is still holding 186. I think support wise, if it does retest 179, 180, it should be able to find some good support and for some bounce. Yeah, but for now, it looks like still some sideways currently. Okay, and then next question is on Franken. Okay, Franken, I think for now, still quite bearish. I think currently retested this 125 previous range support level. So over here, if price can hold, it could do a bit of a sideways over here. But I think resistance wise, it's around 130 over there. yeah, still quite, since the price action is still quite bearish for now. For Sembcorp Industries, not too much. Still, price action is still pretty sideways over here. With support around 515, then resistance, short-term resistance will be around this 530 level where price is broken down recently and doing a retest currently. Yeah, so I expect still further some further sideways action. Okay, then for Keppel Corp, price broke below the 680 level and then trended a bit lower to test near a support around 650, some rebound. But I think short-term wise, the trend should be still remain quite weak. Resistance probably around the 670, 680 zone over here, then support about 665 over here. So it's either probably some sideways or continue trend a bit lower in the near term, the current pullback. Okay, then next one is on Applied Materials. So Applied Materials, after recovery back above 198, price has retested the resistance area close to around 213. So I think for now we should see possible some sideways from some possible near-term resistance, but I think should hold the support around 205, 206 in the near term. So maybe some sideways action for now. For Micron, I think for now, broken above this downtrend resistance line, and also the horizontal resistance above 150, 116. So for now, looks like some sideways action. If you can clear this 121, 122 level, should be able to see some further upside towards like 126, 127. And for Qualcomm, I think it's still looking positive after the gap up over here. This prior resistance at 175 has acted as a support. So there's some sideways, I think, but I think still looking more positive on the upside. You can break the recent resistance at 183, I think could likely still trade towards the new high levels. Okay, then for Meta, okay, Meta, some rebound recently after price managed to clear 445. Also managed to rebound back above 455, this previous support level. So I think for now, continue a slow grind upwards again, but likely to face some resistance at around 483, this prior strong support level. And I think price will sort of do a slight pullback and do some sideways consolidation thereafter. Then next one is on Amazon. Yeah, Amazon currently looks like a retest of close to 189, 190. Looks like a current double top for now. So maybe some sideways consolidation to take place first. While support is around 184, 185 for the time being. Yeah. Hi BY. Yeah, the TA for Pfizer is still valid. Yeah. Thanks. Okay, next question is on Dell. Okay, for Dell, I think looks like an ascending triangle for the time being. So another retest of the resistance at 131. Maybe some slight pullback again. But overall, I think in the longer term, it should be able to still make new highs. With the recent price action, price breaking above 125, 126, this resistance to go higher. Also, we have this upward sloping support line as well. And for Salesforce, I think nothing too much for now. Still in this range consolidation. I think so. We need to observe a break, either below 268 or 280 to determine the next short-term direction. Yeah. Okay, then for Netflix, okay, price also rebounded back above 580 resistance. Then currently some also filled this gap over here, but I think should do some sideways over here for timing, given that this was a prior support over here. It's around 610. So yeah, I think then short-term support will be around 595 about there. Well, I'm expecting some sideways consolidation for the time being first. And for DraftKings, okay, but I think price is holding along this uptrend support line over here. Also, then also rebounded after a retest of the around the $40.60 support level. So it looks like some sideways still for time being. Resistance still holding at this this support breakdown previously around close to 45. So I think likelihood is still some sideways price action for time being. Next one is on Genting Singapore. Okay, today they will gap up after the earnings release. We tested 94 cents this prior support level breakdown. So I think for now still some resistance at this level. While support should be around 91 cents level, I think. So maybe some sideways first, in my opinion. Okay, the next up is on iFast. Okay, iFast, I think some slight pullback recently. Likely could do a retest of these $7, about 7.10, this range breakout area. Should be able to find some support and do some bounce gain. And then while currently short-term resistance is around 7.35 over there. Okay, any insight on sudden price collapse on Food Empire and Wilmar? What's the outlook? Okay, I'll keep my TA perspective. Okay, for Food Empire first, I think pull back towards this main uptrend channel support over here. Then this was a retest of their prior range resistance around the 107, 108 level. So currently seeing some rebound. I think for the time being, likely some sideways as still likely be some resistance at 117, this recent breakdown level. Yeah, so I think some sideways over here, if you can form a higher low, then there could be some chance for some rebound to take place. And then for Wilmar, okay, for Wilmar, I think price action wise is still rather weak. From like resistance at 343 over here, double top. Then price broke down this low over here at from close to 325 and this support level as well. So with that, I think price could still trend lower in the short term. Next support level probably around close to 309, 310, this area. Next one is on CICT. CICT, I think still nothing too much, quite sideways recently. So resistance is still close to $198, $2 at level. And support is closer to about 190, 192. So I think we'll still probably see some sideways for price action for now. Okay, then for Capital Ascenders, we also the same. Rather sideways price action. Support is still holding around 253. Yeah, but yeah, still quite sideways. And Mapletree Logistics Trust. Okay, price doing some recovery to do a retest of this price support level breakdown at around 138, 139. But for now, I think still some likely is still consolidating a bit of range with support around 134, 133, 134 over here. The next one is on SPBO, which is a Spider Portfolio Corporate Bond ETF. For now, I think the overall trend is still in this downtrend channel over here. Price recently did broke out of this 28 to 30 level to do a retest of this price support breakdown over here close to 2860. I think over here could hold as some resistance. We might see a slight pullback to sort of retest this this resistance breakout recently at 2830. And next one is on BBCB, which is JP Morgan Beta Builders Investment Grade Corporate Bond ETF. Okay, so for this, I think similar trend as well. Similar as the counter mentioned earlier. In this downtrend channel, also recently rebounded to retest this support level breakdown around 480. So I think we could see some slight pullback towards like 430 again to retest this breakout recently. But overall for this counter, the volume is pretty low. That's why we're seeing a lot of gaps over here. So PA wise might not be that reliable for this counter in my opinion. Okay, next one is on Bank of America. Okay, Bank of America still some sideways consolidation. So still some resistance still holding around 38.40 about there. But positive is that seeing higher lows being formed. So I think with that it can form. If you can continue to form higher lows, I think likelihood is that you should be able to see some breakout hit to trend higher. Then the next key resistance is likely to be around $40, 20 cents, $40, 30 cents area. And for Wells Fargo, I think is still one of the strongest among the US big banks. Trend wise is continuing on its bullish trend continuation after pullback, and then we see price did a U shape and retest the recent high and make a new high over here. So likelihood is that price continue to trend higher to make new highs with the recent consolidation. With the breakout of the recent consolidation. The next one is on US Bancorp. For this, I think some sideways, I think is still quite likely for now. Price is just still finding some resistance around 41.80 over here. Then we're seeing support around $40.50. So yeah, I think some consolidation is still likely for now. Okay, then for Mapletree Industrial Trust, I think for now it could still remain under some weakness with the breakdown below 220 recently. Then price is forming a bit of lower highs along the way. So we could see another retest of the recent support around 214, 215 area. Yeah, then if it cannot hold, then we could see a lower low being formed towards like 210. The next one is on city developments. I think currently still some sideways probably going on. Retest of this resistance breakout around 580, close to 590, pulling back from the resistance around 610 over there. So there are still some, I think for the short term, likely to see some consolidation going on. The next one on Aztec Global. Okay, price managed to break above this trendline resistance, also clear above the resistance 96 cents. So for now, we could see price test maybe like close to $1 resistance over here. Yeah, then for now, it will likely hold a 96 cents breakout as a support. Then for CSE Global, I think the trend hasn't changed. Still very sideways in this range consolidation. Nothing has changed. Okay, any insights on significant price drop of Viacom recently? I think recently it's just continuing on in this range. So I think nothing much has changed. Yeah, still finding the support is still around 131, 132. Current resistance probably around 137. Okay, next one is on BYD. Okay, BYD I think is still, the trend is still intact, still in this uptrend. Recently some pullback from the resistance at around 230. So I think if it does retest maybe at 216, this resistance breakout level, which was a very strong resistance, there should be with some support coming to do a bounce of it. The next one is BYD Electronics. For this, I think recently there was a break above this downtrend resistance line as well as this resistance level at $32. So I think price could continue its recent momentum towards maybe the next resistance level close to 37.30, about there. Okay, I'll just take one more question in view of time. This one is on Baidu. Okay, for Baidu, also price is continuing. After the breakout of this downtrend resistance line, price also broke above the resistance level at 106. Their back test, I think should be able to hold as support over here. So I'm thinking price could continue to move higher to retest like this 111 again, then slowly towards a resistance higher around the higher resistances around 119, 120 level. Yeah, so apologies, I can't answer all the questions in view of time. Feel free to post your questions in our Braintree community group on TA. And then I'll take it from there. Thanks. So I'll just hand over time back to Jonathan to close the session.
Yeah, Azim, thanks. I'll do it because I think I have one more question. Yeah, maybe we can go back to the slide about the QR code also while I answer this question. Okay, so last question before we close. Do you think it's still safe to buy bank shares as they have risen too high so far? If interest rates stop rising, will bank shares hold steady or go down? Can I advise on the 3 local banks? Yeah, that's a very good question. I think it's the reason why it has suddenly shot up so much is because, I think it's due to the Feds being very sort of like they're not really indicating that they're going to give as much cuts. Yeah, so that's the reason why suddenly everyone rushed to the bank shares because, most people think that higher interest rates means good for the banks, right? But, I can only speak on the bank's earnings and whether or not they can sustain that, right? So if you look at the banks, the higher interest rates, of course, is very good for them because they can, earn higher yields, for both their loans and their assets that they get. But also, if you look at it on a longer term basis, higher rates may not actually be as beneficial to them as what everybody would think, right? You look at the several factors. It's mainly their cost of funds. If rates are so high, they also have to pay higher costs for their deposits, right? So that's going to push up their costs, which is what we are seeing now. So we know our rates have not been cut yet. Their NIMs are slowly getting compressed, and getting smaller and smaller, right? So that might also be a reason because their cost of funds have started to creep up towards their loan use. But then loan use, they can't really push it any higher because, they're sort of capped, right? So their cost of funds is actually creeping up slowly and slowly and slowly. They are trying to mitigate this, of course, by putting some of these excess deposits which they have back into higher yielding sort of like securities, or other higher yielding interest assets. So that's what they have done, and they have done that, and they have maintained their NIMs somewhat around a acceptable level for them. But there's only so much you can do this rollover for their excess deposits, and it will reach a certain point where whatever they put in this year will be the same yield as they put in next year, right? If assuming that the interest rates are exactly the same, so that also will reach a certain limit. And I think the last factor for the banks, why higher interest rates may not be exceptionally good for them is because, at least for the long term, right, is that the loans growth will take a hit. So if you see loans currently, it's quite it's been on the decline, but at least now it's been improving slowly, right? It's not like we have seen in the COVID days, where interest rates were almost zero, and then loans was like loans growth was really high. So that's also another factor because that also plays into part their net interest income. Because if loans growth is so low at low single digits, they can't really use the excess deposits to grow their loan book. So we are seeing that as well. And we are hoping that if the interest rates do go down, then at least their loans growth, the higher loans growth will sort of offset the lower NIMs. And if you look at net interest income, it will be either flat or it might even grow a little bit. And lastly is their fee income. So fee income, the reason why, if you look at the first quarter, why it did so well, and I would think that this is just my opinion, but why it did so well, it might also be because people were expecting, the investors, their customers were expecting that interest rates are going to be cut. So in order to get ahead of that, they would have to pull out all their deposits, which maybe the tenure has expired, has lapsed already, and the current deposit, the fixed deposit or even current account is not as attractive anymore because the banks have all sort of kept it and they have not really given as good rates, right? So they realize that, okay, it's a good timing now. They're expecting interest rates to go down, so they're going to take this money and put it back into the investment products, which is the wealth management fee income for the banks, which is why we saw this sudden spike. So if interest rates are still very high, then these investors and these customers might not put as much of their deposits into their wealth management AUM or even their fee income. So if the rates go down, then these customers will move towards their fee income. So there's a lot of moving parts, but I guess if you think about it in a very long term, if it's really longer, then I don't think the higher interest rates will really be very beneficial to the banks at least. But whether or not the market reacts that way is also quite hard to say. But currently, yeah, I think it's they're looking at the higher interest rates being more beneficial than detrimental to the banks. Hope that answers the question. I think we have really tried to answer. Oh, maybe there's one more. I think this person. Okay, so I think it's been answered already. Okay, so I think that's all we have for today. Thanks so much for joining us. We overshot by a few minutes, but I think we have a few questions that are left unanswered. I think it's for Paul, but if you can just put it into the Poems mobile app that we have here, you can just scan the QR code and put in the questions, join the community group, and we will try to answer it within a day or two. Any questions you have. Okay, thanks so much again for joining us. I think we'll just conclude the session here. Okay, thanks. Bye.
Recording stopped.